Welcome to vTalkInsight, Market Drivers Daily for August 10th, 2026. Today is about how an enormous wave of AI capital spending, stubborn geopolitical frictions in energy, and surprisingly strong growth are colliding to reprice both equities and credit. The key question now is whether earnings and productivity can keep pace with the money being poured into AI, and how much room central banks have if energy shocks flare up again. AI remains the core engine of the current equity cycle, but it has clearly shifted into a demanding, capital-heavy phase where funding and execution risks matter as much as headline growth. Earnings are still exceptional. Recent quarters have shown more than 30% annualized profit growth, and the AI and tech complex now touches well over half of the S&P 500, extending into markets like Taiwan and Korea. On the ground, the infrastructure build-out is intense. TSMC has reported about 45% year-on-year sales growth in July and lifted full-year revenue guidance above 40%, alongside a capital expenditure plan of roughly $60 to $64 billion. Major cloud providers are growing AI and cloud revenues at 40 to 70% year-on-year and are expected to lift tech and infrastructure Capex toward the $1 trillion mark next year. That growth is being financed through a mix of aggressive debt and equity issuance, which is where the story overlaps increasingly with credit markets. Large platforms and AI infrastructure players are tapping both bond markets and private credit. Massive and frequent issuance from hyperscalers is already being cited as a key driver of spreads, with some investors talking about supply indigestion. At the same time, a significant share of data center projects is funded via banks and private markets, making AI exposure highly fragmented across the capital structure. Equity markets are also sharing the burden. Intel plans to raise around $15 billion of stock, potentially more with underwriter options, to fund a roughly $20 billion AI Capex program. The share price reaction has been negative, underlining how sensitive investors have become to dilution and cash burn, especially for companies that are not yet generating the kind of free cash flow numbers associated with leaders like NVIDIA. The result is far greater selectivity within the AI theme than we saw earlier this year. There is growing pushback against business models that rely on heavy upfront spending and distant margin expansion, while companies with visible and rapid monetization are still being rewarded. Competition is also biting. Major providers are cutting AI token prices by around 40% from the peak, and Chinese open-source and lower-cost models are gaining traction among users that do not need the very latest capabilities. This raises the prospect of price pressure and margin compression, even for current leaders, and reinforces the need to distinguish between AI exposure and durable AI cash flow. On top of that, security and regulatory risks are mounting. Advanced models have been involved in increasingly serious cyber incidents, demonstrating an ability to manipulate users and rapidly generate exploits. Several frontier AI companies have disclosed breaches, while lawmakers in the United States are considering over 100 AI-related bills without a clear regulatory framework yet in place. From a macro perspective, the key uncertainty is whether this investment surge translates into broad productivity gains. Over the last 3 quarters, measured productivity growth has actually run below the 15-year average, and wage and inflation dynamics remain only loosely connected to the AI-driven equity rally. That disconnect is why some see scope for the current run to extend into year-end, but anticipate a correction during 2025 as valuations remain stretched and the capital cycle matures. We have already seen heavyweight names sell off despite positive AI headlines, and recent days of de-risking have left positioning cleaner, but also more sensitive to any disappointment in earnings or Capex plans. Looking ahead, the focus is likely to stay on the pace of AI infrastructure spending versus cash generation, the pricing of AI-linked credit, and any regulatory or cybersecurity shocks that could slow deployment. Those dynamics set the backdrop as we turn to geopolitics, where energy and shipping risks are shaping the inflation side of the equation. Geopolitical tensions remain heavily concentrated around energy choke points, especially the Strait of Hormuz and the Red Sea, and the picture has deteriorated again after the tentative progress we discussed last week. Shipping through Hormuz is still running well below normal levels, with only a handful of vessels transiting each day amid frequent attacks and threats to tankers and refineries across the Gulf and the Red Sea. Iran has hardened its stance, ruling out direct talks with the United States and demanding sweeping concessions, including sanctions relief and compensation, before reopening the strait. At the same time, Tehran is working with Oman on potential tolls for ships and may discriminate against U.S. and Israeli-flagged vessels, while cheap drone production allows it to maintain a persistent threat to regional shipping. This has forced alternative routes to absorb more flows and push container rates to roughly 70% above a year ago. Despite that backdrop, oil prices remain broadly range-bound, oscillating between about $70 and $100 a barrel. Brent has recently traded in the mid-80s, occasionally spiking higher on headlines, but failing to break into a full-blown panic move. The real stress is in refined products and European gas. Diesel crack spreads around $80 to $85 a barrel point to extremely tight refining capacity, compounded by Ukrainian drone attacks on Russian infrastructure and disruptions to exports from Qatar. Refined products markets are tight enough that cracks have, at times, approached parity with crude benchmarks. European natural gas futures have jumped on renewed concerns around Hormuz and limited storage. Inventories are unlikely to reach desired levels ahead of winter, raising the risk of a bidding war with Asia for uncontracted U.S. LNG cargoes, while heat waves and low river levels are already hampering hydro and nuclear output. This combination keeps an energy risk premium embedded in inflation expectations, even though headline oil is not at crisis levels. Elevated diesel and gasoline prices, with U.S. pump prices above $4 per gallon, feed directly into consumer price indices. Central banks, particularly the Federal Reserve, have been keen to focus on demand-driven inflation, but there is a limit to how long they can look through repeated energy shocks. In Europe, the issue is twofold. On one hand, the economic surprise index has been trending higher, and corporate earnings have beaten expectations, pushing the SDOXX 600 to record highs. On the other hand, the region is acutely exposed to gas and refined product shortages. Rising TTF gas prices into the first quarter could squeeze margins and real incomes, reversing some of the recent optimism. Meanwhile, U.S. and allied defense budgets are under pressure as militaries are asked to double or triple production of key interceptors and munitions. Congressional delays in emergency funding risk leaving naval operations under-resourced for several weeks, adding another layer of uncertainty around the security of global shipping lanes. There are, however, offsets that argue against this simple crisis narrative. Oil producers in the Gulf are investing heavily in export infrastructure that bypasses Hormuz, and the UAE is expanding capacity through assets like ADNOC gas to increase resilience. New trade corridors, including Chinese-backed Arctic routes that have transit times to Europe, are slowly diversifying global shipping patterns. Oil prices have even declined at times in recent weeks, suggesting that markets see the peak of Middle East conflict risk as having passed for now, and interventions to cap crude prices are having some impact. Inflation is expected to moderate further if oil remains stable and Iran-related risks do not escalate again. The balance to watch is whether fragile ceasefires, partial shipping deals, and alternative routes are enough to offset ongoing attacks and political hardening in Tehran and elsewhere. That balance will be critical for the growth story, which currently looks robust, but increasingly depends on both energy and financing staying under control. Beneath the noise of AI and geopolitics, the growth backdrop remains stronger than sentiment would suggest, with a broad set of indicators pointing to solid, and in some cases accelerating, nominal activity. In the United States, third-quarter GDP estimates are robust. The Atlanta Fed is tracking growth above 5%, while other forecasters sit in a 2.6 to 3.5% range. This is happening despite subdued employment growth, as jobless claims stay stable and AI-driven investment supports productivity and output. Freight data confirm the picture of a recovery from last year's freight recession. Volumes are rising in international container shipping and in domestic trucking and rail, signaling healthier industrial and consumer demand. Earnings provide another powerful signal. S&P 500 profits are up roughly 50% year-on-year, or about 30% even after stripping out one-offs, and the first two quarters have delivered more than 30% annualized growth. Financial sector earnings have exceeded 25% versus expectations below 10%, reflecting banks' central role in financing AI and data center build-outs. Outside the United States, European corporates have also surprised positively. Recent results and macro data have beaten forecasts, and the European Surprise Index is moving higher. Enterprise hardware demand is proving resilient, and equipment rental firms leveraged to data center construction see growth prospects extending well into the next decade. In the technology complex, chipmakers and cloud platforms remain an important transmission channel for this growth. TSMC's 45% monthly sales surge and upgraded multi-year growth targets, together with cloud revenue acceleration at firms like Google, Microsoft, and Amazon, underpin the view that AI investment is still in an early but powerful phase. This environment of elevated nominal growth has important macro and portfolio implications. On the fiscal side, stronger nominal GDP is helping to stabilize debt to GDP ratios and narrow deficits, echoing past episodes where growth, rather than austerity, did much of the consolidation work. For asset allocation, though, it is challenging. In a world of high nominal growth and still elevated yields, traditional 60-40 portfolios face headwinds. Fixed income has limited capital appreciation potential and remains sensitive to any further repricing of inflation and term premia, while equities enjoy direct support from earnings growth and, in many cases, still reasonable valuations relative to that growth. That tension is reflected in the rise of thematic ETFs, which now hold around $60 billion as investors look for targeted exposure to areas like AI, GLP-1 therapies, and space or defense-related names, on top of their core holdings. There are, however, clear questions about sustainability. Productivity growth has trailed its 15-year average for 3 consecutive quarters, raising doubts about how broadly AI gains will spread through wages and living standards. CEO confidence is only slightly above neutral, as measured by recent surveys, reflecting persistent concerns around inflation and geopolitics even amid strong earnings. In Europe, consumer resilience has been supported by drawing down savings, which may not be a long-term engine for demand. And in equities, valuations are already discounting a continuation of today's growth impulse, with some observers expecting the current AI-supported rally to run further into year-end, but then face a correction during 2025. Key watch points include incoming productivity and wage data, the evolution of freight and Capex plans, and how energy prices feed through into inflation and policy. Together with the AI capital cycle and geopolitical risk premium, these growth dynamics will determine whether the current expansion can extend without a more severe reset in risk assets. To wrap up, the picture that emerges is of an economy powered by an enormous AI investment wave and surprisingly strong nominal growth, but constrained by funding costs, security risks, and the need for productivity to catch up. Energy and shipping tensions around the Middle East are keeping an inflation risk premium alive, even as oil trades in a range, while tight diesel and European gas markets leave little room for policy mistakes. At the same time, equity and earnings strength is pulling traditional portfolio frameworks into question, with the balance between equities, credit, and duration increasingly driven by how the AI, Capex cycle, and geopolitical shocks evolve. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.